All right, everyone, welcome to the Real Estate Game Changers Show. I'm your host, Mike McKay, based in Jacksonville, Florida. And each and every week, we do this show with real estate investors all over the country. And this is a live show, guys. So if you have any questions, please put them in the comments for our guest to answer. This week on the show, we have Mario Datillo. Mario, welcome to the show.
Hey, what's going on, brother? Excited to be here. Thanks for having me on. This is gonna be fun doing it live. Used to doing these recorded, but I prefer live. Makes it more interesting.
Yep, absolutely. So for the people who don't know you, could you tell us about how you got into the real estate business and how that's led you to where you are today?
Yeah, I started actually my first business while I was still in high school. 3 days after I turned 18, I started a marketing business with some
Hmm.
friends, and it ended up going very well for the first, call it 2+ years. The company that we were contracted, though, had some problems, and they ended up filing bankruptcy, and they wiped us out. They cut off our income stream completely, and I learned a good lesson. Don't have one client. um, or they own you basically. And so that caused me to have to get creative, and that caused me to start to have to look for other opportunities. And what I did was my partner and I, one of my partners and I started a mortgage company together. This is like, call it 2006. Everybody had a mortgage company then, right? And we ended up starting that mortgage business together. And shortly after, we had all these clients coming to us saying, who should I talk to about being, for a real estate agent? They wanted a real estate agent referral. And we just saw this over and over and over again. So we got together and I just said, hey, look, I think we should start a real estate brokerage. I'll run it. Now, the funny thing is, I had no real estate agent or brokerage background. I had, completely no experience with that. I'd flipped and wholesaled. Actually, I wholesaled a couple of homes, and that was it. But we went and partnered with a real estate broker who had a lot of experience, and he was retiring. And so we said, look, we'll partner with you. You be the broker of record, and we'll build this out. So 2008 hit, market crashes. I'm helping investors kind of buy and sell stuff. And I go to my dad, who had a lot of construction background, and I just said, hey, look, you've got all the construction background. I've got all this acquisition and disposition experience. Let's partner. And that's how I got into the investment side. Him and I partnered. I shut down the brokerage with my other partner, and we just started buying single families till about 2013 when we bought our first mobile home park. And that was kind of the phase of where we went into commercial real estate.
Gotcha. What made you decide to make that shift in 2013?
Yeah, I mean, it was the big thing is when we got into the single family space, it was really opportunistic. I mean, if you think 2008, everything's in shambles. We were buying in Florida. I lived in Minnesota at the time, but we started buying in Florida after probably 6 months to a year. And it was just blood in the streets, great opportunities. Then,
Mm,
after several years, a lot of that distressed inventory dried up. And now we had to start marketing and finding sellers the old school way, which is, not quite as fun as having deals just handed to you on a silver platter from banks. And like we had bought non-performing loans, we had done a lot of creative ways to buy inventory, but it was just becoming a more traditional market. And we were,
mm,
I would say, sick of the trading business, which is really what that is.
mhm.
And we wanted to get into more of a cash flow strategy where we could buy assets, they'd keep paying us, long term and really build wealth. Actually, side note about that, I kind of had the epiphany when I was at OREA. We have a really good real estate investment association here in Southwest Florida. And a buddy of mine who actually runs the group, we were talking, and I was talking about like scaling up flipping and all that. And he goes, Mario, let me ask you a question. Out of the wealthiest real estate investors how many of them flip houses? I was like, well, none of them. He said they all own cash flowing commercial real estate or very large portfolios of single family rentals. I'm like, yeah, you're right. He goes, so why are you trying to get rich doing something that you'll never get rich doing? He goes, you'll make good money, like you have been doing that, but you're never really going to get wealthy doing that. You're always going to have a job. And so I was like, dang, hit me between the eyes, right? And so that was
Mm,
kind of the epiphany that made me shift my mindset to go, instead of trying to buy single family rentals or do anything like that, I'm like, I need to get into commercial real estate because the way that they're valued is very different. And
mm,
once I realized how commercial real estate was valued and how I could force the value up, it was just a big mental shift. Like, okay, I see how you can get super wealthy with commercial real estate. Even the guys that I know that own a lot of single family homes as rentals, they hate their life. And yeah, they'll get a several $1,000,000 when they sell all that, but it doesn't kick off much cash flow. And on top of that, they aren't ever going to get super wealthy. They're going to
mm,
do well, but they're never going to get super wealthy, even if they own 100 houses. You know what I mean? So
mhm.
it's just a big shift mentally for me.
So you talked a little bit there about kind of the way commercial real estate is valued and forcing appreciation. For the newer people listening to the show, can you explain how it's different in commercial real estate?
Yeah, this is huge. So basically, single family homes are valued based on comparable sales, right? If you're in the flipping game or wholesaling game, that's all you care about is what did the home next door sell for? That's what my home is worth. But that's actually a hindrance because no matter how much money you put into a home, it's only ever going to be worth, you know, relatively close to what the comparables are. Well, commercial real estate is valued based on cash flow, your net operating income. And there's a multiple, based on that NOI. And what's interesting is um, I can buy two mobile home parks, for example, identical, right down the street from each other. And if I can take the cash flow from this one and increase it more than this one, it's actually worth more. Okay. And maybe that
Mm,
wasn't a good example to say buy both of them, but if I can buy one and there's another identical one down the street, I can force the value up much higher than the one down the street based on that net operating income. So not only can I produce more income and put that in my pocket, but I can also force the value up and within a controlled setting. I can take the value and double it in a year.
mm.
Chances are I can't force the value up on a single family home over what the comparable sale is. So it's just you can get really wealthy buying a few deals in commercial real estate, but it's going to take you a lot of homes to ever get to that same level. And on top of that, the valuation just changes the game. I can force the value up. It's called forced appreciation.
And once you force the appreciation, like what's your approach to the asset from that point?
Yeah, so we'll typically buy the property, make the
Mhm,
improvements on it, push the rents up, bring the rents to market, and from there, we're going to typically refinance that property and return all of ours and our investors' capital and just hold it
mhm,
long term for cash flow. We
mhm.
don't typically pull out more than what we have invested in that deal. We want to keep our loan to value relatively low because we want to produce cash flow for the long haul. But yeah, we're going to own it for cash flow for a long time. But we
Gotcha.
want to get our cash out, and we want the bank. Um, uh, we want the bank to basically carry the carry the risk after that.
Yeah. And then, I know over the years, like more and more institutional buyers have gotten into mobile home parks. How has that affected your business?
Yeah, so kind of interesting here. This is a really good opportunity. And if you're looking at mobile home parks specifically as an investment, this is why you should double down because we have what's called consolidation happening right now in this industry. And it only happens once for the most part, right? So you've got mom and pop owners who have owned these communities for 50 years. You know what I mean? The bulk of the properties were developed between the 60s. And a lot of these owners developed these parks with their bare hands. Some of them still even live in the communities and they're retiring and dying, okay, which is a very strong motivation for them. And it's all happening in kind of a wave because they're all retiring and dying at the same time. Well, what happened was some professional investors looked at that and said, that looks kind of profitable. And these guys aren't running this as a professional investment. They're just treating it like a lifestyle business. They own it free and clear. They travel, they live their life, and
Mm,
they got this secret deal between the landlord and the tenant that says, if you don't raise rents on me, I don't expect you to fix anything. And it's kind of the silent deal between the two. And what happens over time is the property goes down in quality. So you start attracting lower quality tenants that are willing to
mm,
put up with the crap for the lower rents. Well, these professional investors look at it and they go, all right, well, we can fix up this property, bring the rents to where they should be, and we can create all this value. Fix them up, make them, revitalize the community really. And then behind the professional investors, I like to say the institutional investors caught wind and they go, wait, these guys have turned this into a real investable asset and making these an institutional quality investment. Why don't we just go buy up all those guys because they've already turned these properties around and made them look really nice and they're at peak performance. Most of those institutional investors don't have the capacity to go in and turn these properties around. They want to buy clean cash flowing properties.
mm,
So it's kind of this two tier. It's the professional investor buys it off mom and pop, gets them happy because they can retire. They turn it around, they build a portfolio of those properties, and then the institutional guys come in and ultimately buy out the whole portfolio at a high premium. And that's exactly what's happening. So
mm.
most people aren't going to be an institutional investor. Most are going to be at the professional level, either syndicating using their own cash or forming a small fund. And that's the opportunity. Acquire a lot of these communities, revitalize them, bring them their values up, and then ultimately someday exit to a large institutional owner.
Mm. And you were saying they kind of had this silent deal where, like, I'm not going to raise your rent if you don't have to fix anything, right? I know,
Yeah.
at least on the institutional side, a lot of the investors, they don't want to own the homes themselves. But what's your
Yep.
opinion on that in your business?
It's the same. Yeah, we
Mm,
really don't want to own the homes. We are like a for-profit homeowners association, if you want to look at it that way. We own the land, the infrastructure, the common area, the amenities, and that's all we want to own. From time to time, we'll get homes back and then we will fix them up and then we'll turn around and resell them. But we're really not in the home rental business. Some of these mom
mm,
and pops have been running these communities as rental communities for 30 years, 40 years, and they got all these home inventory, all this home inventory that needs to be fixed up because they kind of let those do. But it's very common to see communities with roads that are dilapidated, signage that's 30 years old, and just really need some life brought back to them.
So, will you buy a community where the owner owns a lot of homes?
Yeah, yeah, we do it all the time. And we'll typically expire those leases over a period of time. Then we will
Mm,
renovate them and then we will sell them off and convert the community to be completely tenant-owned homes.
gotcha. And when you like, I know there's a lot of different strategies here. If you're selling them off, are you selling them like owner finance, or like, because I know it can be some difficult to get the financing on just the homes if they don't own the land.
Yeah, we don't really do much seller financing. It's one thing if you've got one community and you're selling 5 homes or 10 homes off with seller financing, but frankly, we don't want to mess with Dodd-Frank laws and all that kind of stuff. And so it's
Mm,
just cleaner to utilize bank financing and also cash buyers. Yeah, at some point we may do it, but to do it, we really want to do it right and have an originator's license and a servicing license and all that. And it's just something that we haven't pursued up to this point. One thing that I'll tell you is a lot of people who get into the park space kind of go after the rent to own model. Problem
mm,
with that is they never really own it. They're really just renters in the back of their mind. So you're going to be constantly turning that inventory. And if the goal is to not own the inventory, then it's not the best model, right? Does it mean you
Hmm.
can't do it? No. Like for us, we're looking at a strategy to infill all of our communities with all brand new home, not all brand new homes, but to basically fill up all the vacant lots with brand new homes in one
Hmm.
big swoop. And to do that, if you're bringing in 150 to 200 homes in 2 years, that's a lot to sell, right? So it's just
Hmm.
easier to do a lease and a sales model side by side. So some homes are getting leased, some are getting sold, and then go back through that inventory of rentals and then expire leases
Mm.
and either give those renters the opportunity to buy or just expire and sell that home a year later. They're still brand new inventory. Yeah,
Hmm.
they'll have a little bit of wear and tear on them, but that's maybe a strategy that someone could look at if they're okay with, short-term rental strategy, and ultimately exit those homes. I would never tell someone to buy a rental community. You might as well buy an apartment building because that's what you're running, but you're not going to get the benefit of the apartment building. And the
Mm.
units in an apartment building are going to take a lot more wear and tear than a mobile home. So
Yeah.
I just wouldn't want to run a rental community for a long time.
Gotcha.
One other thing on that, another reason for that too is your staffing and everything is much different. So when
Ah.
you're running a rental community, you're going to need staff more like an apartment. You're going to need
Mm.
full-time, maybe a part-time manager in addition. You're going to have on-site maintenance crew or maintenance staff that does the cleanup and everything where, you don't need that when it's all tenant-owned homes because you're really running a homeowners association that has, those items that I explained that we own is all that needs maintaining. So you just contract people.
Gotcha. And then when you go to sell them off, like, so there are lenders who will loan on just the homes then in the community?
Yeah, so there are they're called chattel lenders, and some
Okay.
banks will actually lend just, your typical local banks. They will lend on manufactured homes, but also um, there are specific chattel lenders. Uh, Berkshire Hathaway owns 21st Mortgage, which
Hmm.
is the largest, in Berkshire Hathaway, everybody knows that company. That they own the largest chattel lender, which is 21st Mortgage in the country, and they finance both retail buyers, but also communities on floor plan credit lines. So very common. Triad's another large lender in the space. There's quite a few of them actually.
Can you explain what a floor plan credit line is?
Yeah, think of like a car dealership.
Hmm.
It's a credit line that a car dealership would order homes or buy used homes utilizing, and then they put those homes on their lot, I'm getting it mixed up, those cars on their lot until they sell it. And it's like a revolving credit line
Hmm.
for inventory for, in this case, manufactured homes, but it's very common in the car dealership business as well. Yeah, so it's like a revolving credit line for inventory.
Gotcha. So that lets you move the homes on there without using all your own cash, and then you're selling them off to, end
Correct.
users.
Yeah, exactly. So they'll finance, call it 70, 80% of the home. And it's just a
Mm.
credit line that you can keep buying homes, bringing them on, selling them, paying it down, and you just can keep on ordering homes utilizing that. So it's like a big credit card, if you
Yeah.
want to look at it that way, with the chattel, with the homes being the collateral.
Are you, when you put like, when you move homes on into your parks, are you always putting new homes or are you sometimes purchasing used homes, putting them in the park?
We used to bring in used homes and fix them up and then sell them. The problem
Mm.
with that model is you end up having um, a lot of surprises, and you always go over, and you always it's just a terrible business model. So we have stopped doing that, and we have only or we're only ordering new homes now because um, it's just so predictable. I mean, yeah, you're buying new homes for um, a lot more money, but ultimately, if I can bring in a home, know exactly what my costs are, not have
Mm.
surprises, sell a brand new product, it improves the community a lot. That's a much better business model. It is harder from a sales side because you're selling at, you know, much higher prices, but we've just found it to be a better business model in general.
Gotcha. And then, like, I guess, like, so when you're looking at a park to buy, is there like a certain number of, you call them pad, I forget the term is in the mobile home park business, but a certain number of basically lots that you're looking to have in that park for you to even consider it, or?
Yeah, lots, pads, sites, whatever you want to call it. Yeah, we typically look at communities with 50 or more occupied lots, just
Mm,
purely because of the scale. You can afford the payroll, all of that stuff a lot better with, 50 homes or more paying lot rent. Now,
mm,
that doesn't mean that we wouldn't look at something smaller if it's really high lot rent. Our average market lot rent is, call it 450 or so. So
mm-hmm,
if we bought a community that had lot rents, in certain markets they can be kind of low, let's say 350 or 300, we'd need a lot more lots to make that number work. Where if it's in a market where lot rents are 600 or 700, then we could actually go a little bit smaller. But kind of a loose rule of thumb would be around 50 occupied lots. You know, buying a community with 50 lots but 10 homes on it, that's a pretty heavy lift, and there's just not
mm,
enough revenue going into it to make it make sense for us. We really want to buy in place cash flow and buy communities that have maybe 75% or more physical occupancy, meaning 70 to 75% of the lots have homes on them, and then
mm.
bring it up to full from there. It's just a much more predictable, um, and um, doable business model than trying to fill up empty parks.
Yeah, I gotcha. Um, so you'll buy these parks, you'll kind of get them up to, capacity, and you're raising a
Stabilized, yep.
lot, stabilize them, and then you're kind of pulling your money out just so you don't have any money left in the deal and the bank's carrying the risk for you.
That's correct. Yeah. So what we want to
Cool.
do is we want to buy it way down here, have a really
Yep.
low basis, make all the improvements, bring the rent to market, bring in better tenants, have the bank look at the new valuation, say, hey, we'll finance up to here, which is our total cost in the deal. Now we're out of the picture completely, and we've got this equity, and the bank has now replaced us, and we have little to no money in the deal, and our investors don't either.
And you were saying 50 occupied lots on average, like covers like kind of your staffing costs and all that. I mean, I know you're trying to get the homes out of your name, so you don't need a lot of those type of positions, but what kind of staff do you need to run a stabilized park?
Yeah, I mean, when you're looking at a property that's already running smoothly, full, you can typically get to about 100 and a little over 100 sites with a part-time manager. I mean, that's very different than an
Hmm.
apartment building where on 100 units you would probably have a you know, you'd probably at least have a full-time manager and a part-time, maybe a full-time maintenance person. We don't need that. So, your expense ratio in general with mobile home parks is lower than most other property types. And this right should get someone to pay attention if they're even remotely considering buying a mobile home park. I can confidently say that you will get wealthier faster buying a mobile home park than most other property types. And the reason I say that is because your typical property will have around, like let's say apartments or other property types, office and other things, you'll be around 50% expense ratio. Okay. Meaning
Hmm.
for every dollar that comes in, you keep 50 cents before your mortgage. And about 50 cents of that is being valued when you're determining the value of the property. But on a mobile home park, you're going to be between high 30s and low 40% expense ratio and we'll just say 40% to make easy numbers. But you're at closer to a 40% expense ratio, meaning that you get to keep 60 cents from every dollar that comes in. So not only do you get more cash flow in your pocket from every dollar you bring in, but remember what we talked about on that valuation. If I pick up an extra 10 cents for every dollar I bring in rent, may not seem like a big deal, but that's 10% more wealth creation for every
Mm-hmm.
dollar I bring in than any other property type. So you literally get wealthier faster and more wealthy buying mobile home parks than any other property type. Because if I buy a 100-unit apartment building that generates $1 million worth of revenue, or whatever, I'm making up super horrible random numbers, but I'm going to actually make $100,000 more in
Mm-hmm.
bottom line numbers, and I'm going to be able to throw a cap rate evaluation against $100,000 more
Mm-hmm.
than the apartment building. Okay, so and side note, don't don't hold me to that. 100 unit apartment building is not typically going to generate $1 million in revenue, but you get my point.
Yeah, I got you. Can you explain for the people who don't know what a cap rate is and how that affects your
Oh,
value?
geez. All right, so yeah, think of it like this: a cap rate is kind of like a cash on cash return when you don't take into consideration a mortgage. All right. So it's like your year one cash on cash return without a mortgage. So free and clear, also known as an unlevered return. Okay. So for
Mm.
example, if I bought a property for $1 million and I net before my mortgage $100,000, you would just take the $100,000 divided by the $1 million that you paid, and that is a 10% cap rate, meaning you're getting a 10% unlevered return. Okay. Um, and the reason that you utilize a cap rate is because it helps you compare deals side by side, and that gives you a better idea of what kind of a return you're getting on deals side by side, but also, that's how the appraiser is going to look at it. You can back into it and you can say, okay, so if the market return that investors need to get for a property is 10%, and you're producing in that market for that type of property and that size of a deal, and you're producing $100,000 NOI, you see how that would get you $1 million valuation. So you can look at it
Mhm.
both ways. That's how you determine the value.
Yeah. And then,
That's a
I'm
lot.
sure it's no, no, yeah. I think it's
Yeah,
just good for the newer people to understand because, then if they add
sure.
at a 10 cap, if they add $10,000 in NOI, they make 100,000 in value, right? Which is a big deal.
Yes, and that's huge. So if you add $10,000 in value to a single family portfolio, guess how much value you created? None. None. Doesn't matter. Yeah, you got $10,000 more in cash flow, just like you got $100,000 or $10,000 more in cash flow on the commercial property, but you're double dipping. You're getting increased cash flow and increased net worth. You just
Hmm.
added $100,000 to your net worth. I mean, like when I do these webinars for my coaching program and everything, and I'm showing people how you can make all this money with mobile home parks, I'll show one deal, and in 2 years we doubled the value and created $1.8 million in equity on one deal. It's like that might seem like an extreme exaggeration, but that's like not a crazy awesome deal. I mean, if you're buying them right, you know how
Hmm.
to add the value and bring them up to full market value, you can be a millionaire in one deal. And that's not like hype. That's not exaggeration. I don't typically look at deals that I can't make $1 million in the lifetime of the deal.
Yeah.
Just, that's, you don't do as many deals. It's not like you're flipping houses, right? But you're doing less deals, but you're doing bigger chunks of wealth from each one of them.
And then, how are you sourcing your inventory for these deals?
The actual communities themselves. Everything that we do, we buy direct from owner. We've got a
Really?
team of acquisition managers. Yeah, I've never bought a park from a mobile home park broker ever in
Wow.
11 years. Yep. Everything is direct. And that goes for most of our commercial property too. I've got a couple of partners that we bought some stuff together, and we've bought a couple of deals, commercial properties, not mobile home parks necessarily, that were through a broker, typically off market still. But I mean, that's like, I think we're about to close our 30th acquisition. So that's a
Mm.
lot of deals off market.
Yeah.
uh, Maybe two or three of them somehow through a broker. Yeah.
And so, I mean, we've had a lot of single family people on the show, and I know how they market for these deals off market. I mean, what are you guys doing to market for them?
Same. I mean, it's people, right? The asset is different, but the seller is the same. It's a human being that owns an asset. And we're doing a lot of cold calling. I get a fair amount of leads from social media as well, and my coaching program. I partner with clients as well, but the majority is just cold calling. Like we have a deal that we closed in December. I worked that deal for 3 years. um, and that's how these deals work. They're slow. You build relationships, which is something most people aren't willing to do. I meet the owner one time over the phone. We start a relationship, we keep touching base, and from then on out, it's like when the time comes that they really are motivated enough to sell, chances are I'm going to buy it. Not always, but they know me, they like me, they trust me, and there's an opportunity to buy that property. And they know that we're going to take care of their tenants. They know that we're not going to redevelop the property and we're going to revitalize it. And they know that we're legit. So it's just a slow process, but it pays off. Like I said, if you do a deal and you're making 7 figures per deal, pays to be patient.
Yeah.
I think we bought more deals last year than we ever have, and that was like 7. It's
Mm.
not a lot. Might sound like a very small amount of transactions for someone who's flipping houses like crazy, but if you can make 500,000 to 1 million or more on each deal, you see how that really moves the needle.
Yeah. How do you structure that with your like acquisitions team though? Because obviously, you know,
Mhm.
they probably want to make money on deals, but when it's a slow burn, it can be
Yeah,
challenging
it's
as
really
a
hard. It's really
salesperson.
hard. It's really hard to find the right people for that.
Mm.
And that's why commercial real estate is such a smaller business, and there's just so many less people in it because most people can't ride out a 9-month transaction. you know,
Sure.
and like if you think about it, a single family home, you're closed in weeks, not even months. These deals, you might start talking to the owner and put it under contract and it doesn't close for 6 months. It's very common. And so people
Mm.
have to be stable financially to be able to do that. Um, we wholesale as well. We wholesale
Mm.
parks and we own a brokerage. So a lot of those leads get funneled through the brokerage or the
Mm.
wholesaling. We don't do traditional listings. Everything's kind of off market, even in the brokerage, but it's they're able to generate income from that. So we're picking and choosing the deals we want to buy, and then we're wholesaling the deals that we don't want to.
Gotcha. And are you focused on a specific geographic area or?
All over the country. We won't buy in the communist states like California or Illinois or New York or New Jersey. Like those are just no-go zones. But generally speaking, we'll buy anywhere in the country, and we're in 6 states right now. So just continuing to grow into different markets. But ultimately, it's going to come down to population and micro demographics. So like down to the zip code. We want to know the population
Mm.
size within the metro, but then we're looking down to the zip code to understand median household income, median home value, and some other metrics that tell us that that specific market is strong. We used to kind of do what I call a sniper approach, where we would market to one area
Hmm.
and we just farm that area. And then with social media and with the coaching program and kind of those things, we're like, wait, we should really just be marketing broadly. And so now we do
Mm.
more of a shotgun approach where we market all over the country and target most markets. And then if we find a deal, we then drill down and we go, okay, we like the deal. Do we like this market? If we like the market, then we'll buy there, kind of plant a flag and try and buy other communities around it in that market. If we
Mm.
don't like the market, then we either pass or wholesale the deal, right?
Gotcha. Interesting.
And that
That-
doesn't make sense if you have a tight marketing budget because it's harder to market broadly, than it
sure.
is to pick the 2 areas you really want to own in. But at some point, it may make sense for someone to go broad.
Yeah. Are you pretty much exclusively cold calling, or is there some other marketing strategies you guys are
That's the
using?
majority. That's the majority. We do mostly cold calling. We do some light text messaging kind of behind the cold calling. We'll do
Hmm.
some mailers, but it's usually when we can't get a hold of the owner, we might send a mailer, a letter to them or something like that to say, "Hey, we're trying to get a hold of you. Can't get your phone
Hmm.
number. Give me a call." So it's mostly cold calling though. Yeah, I mean,
Yeah.
there's no it is the hardest way, but it is the best way to build relationships. I
Hmm.
mean, it takes a ton of time, ton of money. But if I get on the phone with an owner, there's a very high likelihood that I'm going to be able to keep following up with that person and building a relationship. And I'm going to get better deals. I'm going to get more deals. And if I'm in the business for the long haul, why not? Right?
Yeah.
It's not like we're trying to get in and get out. I know I'll be in the business 5 years from now. So why not start building those relationships now?
Yeah.
It's the
How many?
slow but sure and steady way.
Yeah. How many properties would you say are in your target list for marketing?
So there's around 42,000 communities from what we can see that are still operating as communities. There was about 50 something, but they are getting redeveloped into other things and you can't really build new ones very easily. So
Hmm.
there's about 40 something thousand communities remaining, and out of that, we're probably interested in buying, or I guess you could say out of that, maybe 20,000, 15,000 would qualify for what we would want to buy, just due to
Yeah.
size, geographic location, quality, things like that. I mean, we're not buying super sexy assets, but we're buying communities that are, you know, not on a lagoon in the middle of farmland in the middle of nowhere with 30 lots and 10 occupied lots. Like those just aren't going
Hmm.
to be our buy box.
What are some other things that would make a deal just like a hard no for you guys?
Yeah, I mean, flood zones are a big problem. If you've
Uh-huh.
got a community that's in a flood zone, especially like a floodway is pretty much a no-go. Flood zone, depending on what percentage of the property is in it and if there's homes in it, we would, that's going to be a big turnoff. Also, demographics, if you're looking at very low income area, sub
Mm.
40,000 income for median home income, it's just like you would think that you'd want to own a mobile home park in a low income area because there's a lot of low income people, but it's actually the opposite. You really want to own affordable housing in an expensive market because then you have no competition, right? But in a low
Mm.
income area, everybody's homes are being rented for a low, all the apartments are cheap. Everything is cheap because nobody has any money. But if you can offer affordable housing in an expensive area, you're gold, right?
Huh.
Everybody wants to move in. So we want to target higher income, higher home value markets and be the lowest cost provider of housing in that market.
Gotcha. And then I know a lot of people who buy mobile home parks, like I've heard that it's fairly common that you buy on seller finance from the owner. Is that true or?
Yeah, and it really comes down to the seller. I mean, if you think about who we're buying from, the guy who developed a park 50 years ago or 40 years ago, he's old. He's thinking about retiring. He's not interested in getting rich. In his mind, he's rich, right? And he is by all standards, right? He owns a two, three, five, $10 million asset that is likely free and clear as a small mortgage and is living like a king. So what he or she is thinking about is retiring and they need
Mm.
income. And for them, they're not trying to take a big chunk of cash, $5 million, and go find a place to invest that. That's a lot of work for them. They just want to go RVing. They want to go, to the beach. So for them, they'd rather pick up the income stream, not get hit with the taxes, and it's an investment into a property that they already know better than anybody else. So it's a easy transition, especially with taxes being a potential burden for them. Um, it's very common.
Mm.
We did a calculation not too long ago. I want to say it was like over a third of the properties that we've bought are seller financed. And we don't go into the deal saying you need to seller finance it. We'll buy it, with new financing coming in, we'll do seller financing. Really, if the seller will give us attractive financing terms, the same or better than the bank, we'll do it. But we don't ever, go in and say, please, will you carry the financing? That's the completely wrong strategy to take, because now you're asking them a favor. Really, we're doing them a favor by allowing them to carry the financing, because they don't have to pay taxes. They have to sell. They're going to pay taxes if they don't carry the financing, or then they got to do a 1031 exchange, which really sucks and nobody wants to do. So it's really to their benefit. And if we can make the terms work for us, then we'll do it. And that's really, with any property type, how you should treat seller financing. I know a lot of people just go in and all they'll do is buy deals that are seller financed, and they'll pay stupid prices just because they get seller financed. To me, that's the dumbest thing in the world.
Yeah.
Most of the sub 2 deals that are going on right now are just trash. There's no equity. It's a horrible deal. Like, why even do it? But they're just trying to accumulate assets that have no equity. Like, to me, that's just a bunch of that sounds like a very low paying, high liability job that just doesn't make any sense to go after. I want to get equity up front, and I want it to cash flow.
Yeah, absolutely. And then the other ones that, you're not able to, you don't work out a seller finance deal. It sounds like there's a good amount of lenders out there that are willing to finance these things.
Yeah, what a lot of people don't realize is that mobile home parks actually have great financing options. There's this old myth that there is no financing for mobile home parks. Just hop on any mobile home park Facebook group or forum or anything. It's like, oh, no banks want to finance these. No, there's tons of financing for it, but you have to understand the target lender. It's like this. If you go to a commercial bank and you ask them to give you a personal checking account, you know what they're going to say? Sorry, we don't do personal checking accounts here. We're a commercial bank. It's the same thing as if you go to a bank and that wants to finance personal credit cards and car loans and personal home mortgages and say, I want you to finance this commercial property. They're going to go, I'm sorry, we just don't do that. Or we don't do mobile home parks, because they have kind of their buy box, right? It's the same thing. You have to know how to determine what lenders are going to be good lenders for financing mobile home parks, and all the way from local banks to regional banks to CMBS, which is like conduit lenders, agency, which is like Freddie and Fannie, to life companies. They all finance mobile home parks just like they finance apartment buildings. The one caveat is HUD. HUD does not finance mobile home parks, where they do finance apartments and things like that. So HUD is really only good for refinances. They're very difficult to buy things with anyways in the multifamily space. So it's not like you're losing a major option there. But there's tons of financing.
So let's say you found a deal tomorrow and you're trying to line up the financing on it. I mean, there seems like there's a lot of options. Like, how are you deciding, which of those routes to take it outside of obviously just rate?
Yeah. So this is a very long answer, and I'm going to give you an abbreviated version. But typically what we will do is we will buy with seller financing or bank financing, local bank financing, make the improvements. Often the bank will even finance part of those improvements. And then once we've got the property stabilized, then we'll go to the CMBS, the agency, or the life companies, because they will give you much better terms on a longer loan term, but also they will give you non-recourse debt in most cases. And that is a really good thing for real estate investors. Most people underestimate contingent liabilities, they're called, and they underestimate having that debt that they've personally guaranteed, which is basically another way of saying contingent liabilities. It's potential liabilities that could kick in that you could have to float personally if things hit the fan. And so what we want to do is we'll use banks because they're more aggressive on the upfront financing. They'll finance dirtier properties more on a business plan. And then once that property's stable, then you go to the better lenders. They take off that personal guarantee, and now we free up liability from our personal financial statement, and we're
Hmm.
able to continue to stack debt because we're not personally liable for it, right?
Hmm.
And banks aren't looking at that as, shadow risk that that investor has. So if you want to grow large, you're going to be thinking about how to get yourself off of that personal liability. And so
Hmm.
that's why the strategy is, yeah, we'll take some risk up front, but once it's clean, we want to get off that risk. The other thing is too, those loans are typically assumable. And
Huh.
so there's kind of additional strategies within non-bank financing. Those are usually assumable, and they usually will get 30-year amortization. You just get way better terms. It's the best terms you're going to get are from the big institutional lenders, not the local banks. But
Yeah.
they have no vision. They will only finance in place cash flow numbers where the bank goes, okay, you got experience. I see what you're doing. I see how you're going to get there, and they'll kind of take some extra risk with you, but you're also signing personally, which is why they're willing to take that risk.
Mm. And then, what's your typical time from, buying it to doing that refinance where you're going towards
We
the
want to
payment
buy
program?
properties. Yeah, we want to buy properties that we can get stabilized in 1 to 2 years, and our refinance period is anywhere from 2 to 5 years.
Mm.
There's depending on, because even if the property is pretty stable and it's filled up and everything, usually there's a process to get the rents to market, because we're not going to go in if you're $300 under market, which in some cases you can be here on these properties. We're not going to go raise rents $300 in 1 year. We're
Mm.
going to stair step it over a period of time, and what you're aiming for is, when does the value exceed you know 120% or whatever of what you need that loan to be, so that you can refinance at 80% LTV. My percentages might have been off there, but you get the point. I need to
Yeah.
get to a value where I can refinance at 80% value, which covers all the equity and the debt from the initial acquisition. So
Hmm.
sometimes it takes a little longer to get the income up to that point.
Are these lenders are giving 80% LTVs on the refis?
Um, no, it's more like 75. Yeah,
Okay,
70
I
to
was just
75% LTV. I was kind of
yeah,
just using an example, but yes.
yeah, yeah. Gotcha. Well, we're getting close to the end here, and there's always two questions that I like to ask at
Yeah.
the end of the show. And the first
Ask
is,
me the ask me the easy one first.
I'll ask you the easy one first. I'll reverse the order for you.
Whatever that is. Yeah. Okay.
Easy one is, if you could go back in time, give yourself one piece of advice when you were looking for your first real estate deal, knowing what you know now, what would you tell yourself?
I'm going to give you two. Number one is kind of the one you probably hear other people say, and that's, I would get educated. I would try, if
Mm,
especially if I'm going out and going to make large investments and try and buy multi-million dollar deals that are going to make me a millionaire. I would recommend getting educated, so you're learning from someone who's done it. Don't try and learn from YouTube shorts and reels and all that stuff. You're not gonna pull it off. Okay, you're either not gonna buy anything, or you're gonna buy bad deals, and you're gonna wish you didn't buy anything then. So number one, get with somebody who's done it and just download their knowledge and experience. You will save yourself and make yourself, infinite amount of cash. Secondly, is I would work with partners for a long time. Call it
mm,
9, 10 years. I just did everything myself. I found the deal, raised the money, owned the management company, owned the dealership, owned and did everything internally. Okay.
mm,
And that's cool because you own more, but I would be a lot larger now if I would have just teamed up with someone who's really good at operations and somebody that was really good with home sales, and we came together and I was really good at sourcing the deals and raising the capital. We would have been so much further ahead, because you can leverage other people's skill sets, and so you're more efficient, but you also have more time to just do what you really enjoy doing. So I would
mm.
say, if you're doing like houses and smaller transactions, it probably doesn't make sense as much. But if you're doing larger transactions where, like I said, you've got big upside per deal, where you can chop up those profits a little bit, do it. It's worth it. And then Yeah, I would say those are my two biggest.
Yeah. And the second one is the what is the craziest or most uncomfortable situation that you've ever experienced in a real estate deal?
Yeah, I mean, I would say that on a couple of occasions, I have had sellers try and, well, let me give you a better one. Okay, I don't know if this is craziest, but a recent deal, I'm talking to a seller and
Hmm.
we have terms in place. And he's supposed to be carrying the financing for it. And there was a little bit of a contingency in the contract that said, the interest rate will go down or up based on what the IRS determines the minimum interest rate can be.
Mm.
And it went down. And in this conversation, he goes, well, I think we should just leave that interest rate where it is. And within literally two sentences later, he's asking me for a couple $100,000 worth of uh, benefit to him in the transaction. And um, it may not sound like a crazy scenario, but it's a good example of how working with people in real estate transactions can be very unpredictable. Here, you're
Mm.
shaking the guy's hand, you think you've got a deal, everything is clear as day in writing, and now they just change their mind and they say, you know what? I don't think you should get that. I think I want it to lean in my favor instead of yours. And by the way, can you help me out with this thing? And it was almost like, am I talking to two different people in two different deals? Because you just told me you want to screw me. And at the same time, you asked me for a couple $100,000 favor. And that's probably a good example of how weird these deals can get. Or
Mm.
I've even had a couple of deals where the seller just says, I don't think I want to sell anymore. And it's like, okay, we close in a week. Um, I this isn't a conversation we're having right now because it's not going to end well if this is how it continues. And on a couple of occasions we've had to sue for performance because the seller just digs their heels and goes, "Nah, I'm not going to sign." It's like, okay, all right, we're back to this game again. Let's get the attorneys involved. We'll each burn 20, 30,000 in legal and burn a couple of months, which basically just helps us because they're running the property, rents might be going up, whatever, values might be appreciating, and we're buying it. It's like an option, right? It's like a $20,000 option on the property. So anyways, I would say that there's some weird stuff that happens when you're dealing with people and emotions that you just have to be prepared for, and
Mm.
that can make these deals much of a roller coaster. I mean, I'm a deal junkie. I think my adrenaline, I love it. One day I'm like, oh, I hate my life. This sucks. And then the next minute I'm like on top of the mountain, like screaming at the top of my lungs. This is the best day of my life. But then usually 30 minutes later, I'm back down in the valley again. So it's really a roller coaster. But I think if you go into any real estate investing or business in general with the expectation that it's going to be a roller coaster, you will be much more prepared and be able to handle it better.
Yeah. I think that's a good piece of advice. Um, Mario, if people want to reach out to you after the show, if they have questions or they have deals, or maybe they're interested in your coaching program, how can they go about getting in touch with you?
Yeah, there's really two people that should get a hold of me. Number one, somebody who actively wants to go out and buy mobile home parks, wants to learn how to do it. You can go to getrealcashflow.com, or you saw on the screen it was mariodatillo.net. You can flow through to that. Check out the education program. If you're more like, hey, I've got money, I want to own mobile home parks, self storage, light industrial, or RV parks, then go to equitygrowth.net. And that's my fund. We're buying these assets, been doing it for 12 years now, have an awesome track record, awesome team, and you can just ride the roller coaster from a distance and ride the highs and not have to feel the lows quite as hard. Let us do it for you and make great returns and have fun with it. You get to have fun, be a deal junkie without having to actually deal with the work side of it. So appreciate you having me on, and this has been a lot of fun, and hopefully we gave some real value to listeners, and
Yeah.
hopefully I can help them.
Yeah. Well, awesome, man. Thanks for being on the show.